If you're buying a house, how do you know which loan option is best? Let's face it, not everyone fits into the scenario of a 30-year fixed conventional loan. Everyone's different. They have different credit scores, different types of employment, different sources of income, different life stages, different down payment savings. They're buying different types of properties. You get the idea. What works for one person might not work for the next. So if that's the case, what are the options? I'm going to highlight the 7 most popular home loan products that we're using today to help people become homeowners. Let's start with the conventional loan. The conventional loan has a down payment requirement of 3% for first-time homebuyers and a credit score requirement of 620 and above. Most people choose a 30-year fixed conventional loan, although you can get a 20-year, 15-year, or even a customized term limit, or opt for an adjustable mortgage, called an ARM, adjustable rate mortgage. Typical terms for an adjustable rate mortgage are 5-year, 7-year, or 10-year, meaning that's how many years your interest is fixed before it becomes adjustable. A conventional loan will have a monthly mortgage insurance if you're putting less than 20% down. 2 key factors that determine the cost of your monthly mortgage insurance are how much you're putting down, your loan to value, and your credit score. The better your credit score, the cheaper your monthly mortgage insurance will cost. Debt to income ratio target for a conventional loan is 43%, although there is some flexibility depending upon credit and reserves. Next is the FHA loan. This is a government-backed or guaranteed loan. As a first-time homebuyer, you can put as little as 3.5% down, and you can qualify with a credit score down to 580. In some cases, you can qualify with a credit score of 500, although you'll need to put at least 10% down and your interest rate will be higher. The FHA can come with fixed or adjustable terms. Appraisal requirements for an FHA tend to be a little bit more stringent than a conventional loan. An FHA appraisal will flag any type of safety hazard, even down to chipped exterior paint. Usually FHA rates are lower than conventional, although you do have an FHA Upfront Funding Fee of 1.75% of the purchase price. This amount is usually just tacked into your loan amount. The FHA loan also requires a monthly mortgage insurance regardless of how much you put down. If you're putting less than 10% down, your mortgage insurance will stay with you the life of the loan. If you're putting 10% or higher, the monthly mortgage insurance would fall off after 11 years. This monthly mortgage insurance is calculated at 0.55% of the loan amount divided by 12. For example, if you have a $400,000 loan amount times 0.55% equals $2,200 divided by 12 means your monthly mortgage insurance cost would be $183. Debt to income ratio for FHA is at 43%, and again, there is some flexibility based on credit and reserves. Next is the VA loan for veterans or active duty military. The VA loan has some amazing benefits, one of them being 0% down. You can finance up to 100% of the purchase price. Certain fees are capped, and there is no monthly mortgage insurance. The VA loan is also guaranteed and backed by the government, and it does have an upfront funding fee as well. They call it the VA funding fee, and it's 2.15% of the purchase price. This upfront funding fee can be lower if you put money down or you have a service-related disability. The VA loan has no real strict caps on debt to income ratio. They're more concerned with what's called the residual income after all monthly expenses are paid. Another type of government-backed loan is called the USDA loan. This also allows for 0% down. The USDA loan is designed for rural properties. The USDA loan has a 1% upfront funding fee, which again can be added into your loan amount, and a monthly mortgage insurance that's calculated at 0.35% of the loan amount. To qualify for a USDA loan, the property must fall within an eligible area on the USDA eligibility map, and the borrower must meet the income requirements of 115% or below the median household income of that area. The debt to income ratio is usually capped at 41%, although you could find some flexibility from bank to bank. Another popular loan that is often overlooked is called a bank statement loan. This loan is specifically designed for self-employed business owners. Business owners and self-employed people usually use their tax returns to prove their income. The problem is, once the CPA is done with all their legal deductions, a self-employed business owner sometimes does not show enough income to buy a house. A bank statement loan will use 12 or 24 consecutive months of bank statements to prove the income. This is done by calculating the average monthly deposit, applying a 50% expense factor, and what's left over is the qualifying income. For example, if the bank statements show an average deposit of $24,000 a month, apply the 50% expense factor, that leaves $12,000 a month as a qualifying income to purchase a home. In some cases, depending on the type of business or even a letter from the CPA, the 50% expense factor can be reduced as low as 25%. Down payment requirements can range from 10 to 20%, and the debt-to-income ratio can be stretched up to 50%. Another solution-oriented type loan is called the asset depletion loan. Instead of income being calculated from pay stubs or tax returns or even a pension, the income is derived from assets. The bank will calculate the total amount of assets from savings accounts, IRAs, retirement, investment accounts, and divide by 60 or 84. When dividing by 60, it gives more qualifying income, but the interest rate will be a little bit higher. For example, let's say a borrower has $1 million in total assets. Divide that by 84, and that borrower would have $11,904 a month of qualifying income. This loan is perfect for someone who doesn't have steady or sufficient monthly income, but has considerable assets. This income can also be combined with W-2 income, Social Security, or pension income. Down payment requirements typically start at 20%, and there is no monthly mortgage insurance. The last loan I'll mention is called the DSCR loan, Debt Service Coverage Ratio. This is for investment properties only. This loan is qualified based on the rental income of the property you're purchasing. The income can come from short-term or long-term rentals. Investors love this loan because they are not bringing their own employment income and debts into the calculation. If the rental income covers the mortgage expense, the deal qualifies. It's that simple. 20% down and a FICO score of 660 and above. So just because you don't fall within the guidelines of the 30-year fixed conventional loan, don't count yourself out. Talk to a loan officer who can consult with you and offer a solution that works best for your unique scenario. My name is David Walterman. I'm a loan officer with Ease Mortgage, and I'm licensed in California, Idaho, and Washington. I'm always available on my cell. Feel free to reach out. I'm always happy to help.